So we'll hereby call the special meeting for the City of Palm Springs City Council Finance Standing Subcommittee. Today is Monday, October 11th. It's 3:01 p.m. This meeting is being held pursuant to the executive orders for the Brown Act, allowing this meeting to be virtual on Zoom. We noticed a link for public participation, and we also allowed public comment to be submitted ahead of time. And we also have an item on this agenda for public comment now. So with that, the first item on the agenda is public comment. Pursuant to the Brown Act, public comment is limited only to the items that appear on the notice and agenda of special meeting. So is there any public comment now? If you have public comment and you're on Zoom, you can use the raise hand feature at the bottom of your screen, or you could physically raise your hand and we will call on you. And if you're on the phone, you can press *9 to raise your hand on Zoom. So is there any public comment at this time? Seeing none. We will go to the next item, which is the quarterly review of city investments and presentation from Chandler Asset Management. Thank you. We're ready for the report when you are.
Hi, good afternoon. My name is Mia Corral Brown, and I'm a Senior Relationship Manager at Chandler. I want to thank the Mayor and committee members for asking us to present this afternoon. Today I have Christopher McCary, who will be presenting the economic update and review of the investments. Chris is a Senior Relationship Manager, a Senior Portfolio Strategist, and a member of the investment team. With that, I'm going to go ahead and turn it over to Chris. But as we go through the data, if there are any questions, feel free to interject or raise your virtual hand, and we would love to address any questions or comments that you may have.
Perfect. Thanks, Mia, and good afternoon, everyone. As Mia had said, my name is Christopher McCary. I'm a Senior Portfolio Strategist with Chandler Asset Management. What we'd like to do today is first just go through, kind of give a brief economic update, kind of a review of some of the economic detail, especially leading indicators that we review. And then we're going to go through the city's portfolio as well as the process, as Nancy had mentioned. And like Mia said, if there's any questions, please feel free to interject or raise your hand. We kind of like to keep these interactive as we go through the presentation itself. So first off, with the economic update, and kind of as we view the overall economy as we move into the fourth quarter of 2021, the theme from the economy continues to be, so goes the virus, so goes the economic activity. We have seen, especially during the summer and now into early fall, the impact that the Delta variant has had, definitely having some challenges and disruptions in economic activity. In a sense, what we've seen is some labor market disruptions and as well as continued supply chain disruptions. Overall, though, the economy continues to move in that path of full recovery, getting back to pre-pandemic levels. In fact, GDP has actually already recovered to pre-pandemic levels. We still have an accommodative Fed. The Fed continued their accommodative policy at their September meeting. However, they did indicate that we could start seeing a change to policy specifically related to their asset purchases they make on a monthly basis that I'll get into in a little bit more detail. And with that, what we've seen is the yield curve has steepened. I know as of this report was details for as of August 31st, but over the past couple of weeks, we have seen the yield curve steepen as we move into the end of 2021. Now, one of the big themes we have seen, especially relative to the economy, especially the impact from the overall Delta variant, is recent impacts from the overall employment report. On Friday, we received the September non-farm payroll report. Now, this, as of the production of this report, this is only showing the data as of August. In August, we had an unemployment rate of 5.2%, represented by the U3. You can see that chart in the upper right-hand corner. But what we saw in September, there was an expectation that we would get around 500,000 new jobs. And unfortunately, only around 120,000 came in. The unemployment rate did drop, though, down to 4.8%. So it's the first time since the pandemic we've seen the unemployment rate drop below 5%. The participation rate, though, did uptick a little bit to 61.6%. But it's still below the pre-pandemic level of 63.4. So what we've seen the past two non-farm payroll numbers in August and September is they have not met expectations. So we still seen some challenges relative to the overall labor force. There was an expectation we would see some positive numbers in September due to the fact that the enhanced unemployment benefits from the American Rescue Plan expired in September, but that has not been the case. So even though that number is still positive, moving in that positive direction, especially that August number of 235,000. Pre-pandemic levels, that would have been a great number for the non-farm payrolls numbers. But however, we're still seeing that disconnect that exists relative to the labor force, as well as to the amount of job openings. One of the things we are seeing is average hourly earnings on a year-over-year basis have ticks higher, as it mentioned here in the dialogue at the bottom of the page, up to 4.3% from 4.1%. And there's a little just challenging with that because the impact that it could have on overall inflation relative to wage inflation. So the Fed has two mandates: full employment and stable prices. And as we've seen, one of the biggest themes over the summer has been inflation and the inflation numbers. And if we do continue to see some challenges from the labor force, and we actually start to see an uptick in wage inflation, that could actually make inflation be a little bit more sticky than the relative dialogue we've been receiving from the Fed, as they've been indicating that inflation was definitely going to be transitory. So one of the things we have seen is inflation numbers. You can see here with CPI up 5.4%. In August, it was at 5.3%. So we saw a little bit of pricing pressures ease a little bit, and especially with PCE coming in at 4.2% for the month of August as well, was not ready for the production of this report. But one of the challenges we have seen from inflation with those increased pricing numbers is representative of the fact of that base case. So comparing to where prices were in 2020 to where we were in 2021 has definitely seen increases in CPI. One of the biggest drivers of that earlier in the summer was actually used car prices, as rental car companies had to restock their fleets. So there has been some evidence of some transitory impacts to inflation, but especially with the recent uptick in COVID, with the Delta variant, especially globally, there has been some supply chain challenges and disruptions. And as the Fed has already adjusted themselves their expectation for inflation for the end of the year, where their target was around 3% and now adjusting that up to around 3.7% for the whole year of 2021, there continues to be some challenges relative to pricing pressures. And as we move into the end of 2021, one of the things we are definitely going to look at is whether or not these pricing pressures ease. The Fed has indicated that they believe they will. But if they do not, what type of action the Fed will take in order to address those as we move into 2022. Now, from the consumer standpoint, one of the biggest reasons why we look at the consumer is because 70% of our GDP comes from consumption. What we've seen here is actually, as of this report, we saw an uptick in retail sales in August. I know this is only showing July, where it was up 15.1%. It was interesting because the numbers for August were expected to decline, especially from the impact from the Delta variant. But when we remove vehicles, gas, retail sales were actually up 2%. But what's interesting with the consumer is actually the change in behavior that we're starting to see. And we want to see if this trend continues, especially the impact from the Delta variant. Earlier in the year, especially in the spring and the summer, what we saw was the consumer was modifying their behavior from actually going and purchasing services instead of purchasing goods. So how I view this is they weren't sitting at home ordering stuff off of Amazon. People were going out. They were going to restaurants. They were going on vacation. They were staying in hotels. They were going out to baseball games. However, that changed in August. We saw that change move a little bit, where all of a sudden the consumer had an increase in purchasing goods versus purchasing services. Now, that could be a byproduct of, in a sense, individuals or kids going back to school, ordering some supplies for school, or definitely the impact from the Delta variant. We did see especially changes in airline tickets, as a lot of some of the airlines indicated that there was actually some cancellations of trips, definitely impacted from the virus. So we continue to see the impact of the virus, and you can actually look at that from the consumer confidence index. We actually saw for September, consumer confidence actually dropped for a third straight month, definitely impacted by the Delta variant to deepen optimism that we've seen. But it is still at historical high levels, and the back-to-back drops could actually suggest just a curtailment in spending as we move into the rest of 2021. The leading economic indicators, what we've actually seen, these definitely depict the economy as actually in good health, and the contributors such as jobless claims, manufacturing, and building permits are definitely driving forces. But the economy is actually suggesting from the LEI that we are in rapidly rising trajectory, and even the Chicago Fed National Activity Index, anytime that number is above zero, that definitely signifies we are in above trend economic growth. One of the biggest drivers that we've seen for economic indicators over the past 18 months has been housing. It's been a bulwark through the entire pandemic itself. In Q2 of this year, across the nation, home prices increased by 23%. And that was the highest increase we've seen on record. So what we continue to see is home prices on a year-over-year basis, up 19%. And what we're seeing is that the dialogue around housing and the challenge that exists is supply, supply, supply. There is not enough housing to actually meet the current demand that exists. The Wall Street Journal came out with an article about 2 months ago showing that the United States as a whole is deficient by 5.5 million homes based off of current demands. So I know that's a theme we generally hear about in California, but that is something that is a theme now that is national. In California, in the month of August, a single family home, the average price was $827,000. That actually increased by 17% on a year-over-year basis. What I find interesting is the fact that 7 out of 10 homes that are actually sold in California are sold above asking. And we're actually seeing right now is that there's only about 1.9 months of inventory available on the market. So there's still that increased demand. We did see a drop in sales for the first time. That was double digits for the first time in 14 months. So I'm not sure if we're actually going to see, like, again, if that trend continues, but housing prices, especially with low interest rates right now and that tight supply, are definitely going to help support prices moving forward. As I mentioned before, manufacturing is definitely strong. The ISM numbers came in at about 59.9 for the month of September. Anytime that number is above 50, as you see that chart in the upper left-hand corner, that's representative of the fact that that sector of the economy is continued to expanding. And generally supporting, we see continued growth for both of these sectors. You know, the chip shortages and the supply chain disruptions definitely can cause some challenges in the near term relative to the industrial production. GDP that we've actually seen here came in at 6.6% for the second quarter. What we have seen recently from GDP numbers is, first, they are back to pre-pandemic levels, or sorry, they're actually better than pre-pandemic levels. So it's one of those areas from the economic data that actually continues to improve. However, what we have seen, especially due to the Delta variant, is a reestablishment of growth for 2021 and 2022. What we're looking at right now is for 2021, growth has declined. It's expecting around 5.9%. Earlier in the year, earlier in the summer, we're expecting around 6.5%, but 5.9 is still very strong and will be the highest GDP numbers we've seen since 1984. And as well for 2022, looking around 4.2%. But these are definitely better than those long-term trends we had seen pre-pandemic of 1.8% from a growth perspective. Now, before I get into the city's portfolio, I'd like to review first off the Fed as well as the current yield curve. So first off, the Fed. Back in March of 2020, as you can see by that chart in the upper right-hand corner, the Fed dropped the federal funds rate all the way to that zero bound range in response to the pandemic. Prior to the September meeting, they had given us the expectation that they don't plan on raising the federal funds rate until 2023. However, at the September meeting, they revealed the expectations that now 50% of the members of the Fed believe the first rate hike could occur at the end of 2022. What's more important on the near term is actually the Fed's balance sheet. The Fed has been purchasing $120 billion of treasuries and agency mortgage-backed securities onto the Fed's balance sheet on a monthly basis. And as you can see here, you can see the Fed's balance sheet is already up and approaching $8.5 trillion. The conversation around the Fed right now is, when are they actually going to start tapering, or in a sense, lowering those asset purchases they make on a monthly basis? The Fed indicated that they could actually start that sooner than expected. There's an expectation that they would start that in 2022. The Fed is actually meeting in November, and we are expecting the Fed to announce in November that the beginning of their tapering, of their lowering of their asset purchases, to commence in December. So in a sense, starting to lower and starting to accommodate or adjusting their accommodative policies that we currently see. We are also seeing other central banks around the world have already started to tighten, or in a sense, starting to raise their internal rate of return for their central banks for their countries. So it's actually starting to see something moving in that trend. We could actually start seeing interest rates rise a little bit sooner than expected, but again, not until the second half of 2022. But next week, we're actually going to be getting the Fed minutes from their September meeting. And what we're looking for is a little bit more clarity on that path of tapering. And it's not so much important about when they start the tapering, but the process and how quickly they go through the tapering of their asset purchases. We're expecting them to be very deliberate, in a sense, stop and complete the reduction of their asset purchases by the summer of 2022. And we're hoping to get a little bit more guidance from the Fed with the release of their minutes next week. From that announcement and from that expectation, what we have actually seen is interest rates have steepened. The yield curve has steepened over the past couple of weeks. First, I want to point to that chart in the upper left-hand corner. You'll notice if we look at the solid green line, it's the 10-year Treasury note, the dotted gray line is the 5-year Treasury note, and the magenta line is the 2-year Treasury note. What we saw earlier in this year is yield curves increased in the first quarter in response to growth expectations for 2021, as well as inflation expectations. And then the yield curve flattened as we came into the beginning of the summer and throughout the summer, mostly due to the impact of the Delta variant. Now we have seen an increase as well in yields over the past couple of weeks. Now it's not representative on this chart in the right-hand corner, but what we can actually see here in the chart in the upper right-hand corner, in a sense, is showing the steepness of the yield curve comparatively where we were a year ago. That dotted magenta line is the yield curve as of August of 2020, and we can compare that to that solid green line in August of 2021. You'll notice that solid green line is flattened a little bit from where we were in May, again, in response to that Delta variant, but it has since then changed and we've seen a steepening, and we do expect the yield curve to steepen as we move into the rest of 2021. That's important for two reasons. One, yield bond fixed income portfolios have an inverse reaction or an inverse movement to interest rate movement. So if interest rates go up, the value of a fixed income portfolio goes down. If interest rates go down, the value of a fixed income portfolio goes up. So we could actually see some negative returns from a monthly basis, but overall it's a benefit because we are being able to invest at higher yields. You'll notice in a sense in that 2 to 3 year mark is where the yield curve steepens. And with our ability for the city's portfolio to make asset purchases in around all the way up to 5 years, the city is definitely going to benefit from the increasing yields as we actually are able to allocate new investments on that longer end of the curve. And that's the opportunity that we're looking at right now. So as we move into the rest of 2021, the theme for the economy is we continue to improve in that positive direction, moving back to pre-pandemic levels. So goes the economy, or as the virus continues to go, so goes the economy. We are starting to see some of those numbers drop. But as we move into the winter, again, with what could be unexpected from the virus, we'll see, but we'll continue to move in that positive direction, especially with activity from the Fed looking to start to adjust their accommodative policy moving into 2022. So is there any area of the economy that I didn't cover, anything you'd like me to go into more detail on?
I don't have anything. Anyone else? Any questions or comments here? Not seeing any. You can continue. Thank you.
Thank you, Mayor. So moving forward, let's look at the objectives for the city's portfolio. The objectives are to provide safety of principal for preservation of capital, provide adequate liquidity to meet all the requirements, and then third, earn a commensurate rate of return. This performance objective is based off of a 1 to 5 year benchmark, and through all market cycles, making sure we are exceeding or equals the return of that index. And then the strategies make sure we achieve these objectives, making sure that the portfolio falls in line with not only for the investment policy for the city, but also with California government code, and also with the strategy definitely focusing on and following a social responsible investing focus for the portfolio for the city. The next 2 pages, I believe, are the most important pages in the entire presentation. What this shows is that the city's portfolio is in compliance with the investment policy for the city, as well as with the California Government Code 53601. Now, to review the portfolio characteristics for the city for the Chandler managed portfolio, what I'm going to focus on is that column in the center. As you can see, the average maturity for the portfolio is 1.59 years. Our duration is 1.53. The purchase yield is 0.50% or 50 basis points. The market yield is 21 basis points. We've got an average credit quality of AA+ and a total market value of just over $132 million. A couple of things I'd like to point out here. First, you'll notice that purchase yield is greater than the market yield. What that means is if on August 31st, we went out and actually made purchases or actually went out and purchased all the securities in the city's portfolio at that time, the yield we would get would be 21 basis points. However, we have a purchase yield of 50 basis points. What that means is we've got unrealized embedded gains in the city's portfolio. So that's a positive. One other thing I just like to comment on, you'll notice the difference between the statistics of the benchmark versus the statistics of the portfolio. We are being very tactical about bringing the portfolio up to and in line with the benchmark. And that's something that we continue to work on with staff. As we get additional purchases, we will continue to move the portfolio, its duration and average maturity to be in line with the benchmark. But again, that's a very tactical process we are going through and definitely being patient with that as well. Now, the sector distribution, as you can see here, here's the breakdown. I'm going to focus on the donut on the left. You can see here that just over 45% of the city's portfolio is in U.S. Treasuries, 35% in agency bonds, 11.5% in corporate bonds, 3.8% in supernationals, with the remaining around in negotiable CDs, money market fund, and one asset-backed security position. Here you can see is the listing of all of the issuers in the city's portfolio. You'll notice the majority of those are in U.S. government debt or with those with the implied backing of the U.S. government. Well-diversified portfolio, and we continue to diversify the portfolio with new assets being placed into the portfolio. And at this time, we do not have any concerns with any of the positions in this portfolio. Also, we follow a guidance in working with staff, making sure that we are investing following the social responsible investing format. We have a target list of approved issuers, and we follow that very diligently. One thing that staff did ask me to point out, though, is the purchase that we made of the Toyota asset-backed securities back in earlier in the summer. Back on June 14th, we actually purchased Toyota Motor Green Bonds, the asset-backed securities on behalf of the city. What these are is they're Toyota auto receivables. What they are, they're auto loans for very, very high credit quality individuals. We purchased about 1.25 million. You can see here the credit rating is AAA. We're able to purchase this at a yield of 0.26%. And the benefit for this is because of the fact that we are purchasing the Toyota Motor Credit Green Bond. So since this is a green bond, and what they are auto loans for individuals to be able to purchase environmentally friendly vehicles. So it's those auto loans for individuals that are going out purchasing Priuses or other of those electronic vehicles as well. So it definitely falls in line with following that social responsibility and that environmental social governance mandate that we have from the city, and in working with staff to continue to apply that into the city's portfolio. Now our quality distribution, and this is based off of S&P. You can see here that as of 8/31, the portfolio, 81.8% of this is in AA rated by S&P. If this was rated by Moody's or Fitch, you would see that all as AAA. The reason it's AA is because back in 2011, the S&P downgraded the United States government to AA from AAA. You'll notice there are certain percentages that are not rated. Those are actually all the CDs and most likely the asset-backed security position. However, the asset-backed security position is rated by Moody's and or Fitch, so it is in compliance with the city's investment policy. The duration distribution here, you can see our term structure built out for the portfolio comparatively to benchmark. And again, as I mentioned before, we will continue to build this out to get the portfolio to be more in line with the benchmark, taking advantage of opportunities we see, as I mentioned before, in that 3 to 4 and 4 to 5 year mark. And as we meet in the next 3 months, you'll definitely see an adjustment, an increase in those areas as we continue to allocate funds for the city. Now, the investment performance for the past 3 months, as you can see here, the last 3 months, the portfolio for the city returned 0.02% compared to that benchmark at 0.7%. And since inception, which is 3/31/21, 0.10% compared to that benchmark of 0.40%. And the portfolio characteristics for the reporting account. So what this is based off of this is the assets that are in LAIF and the other local government investment pools. You can see the purchase yield of 0.15% with a total market value of just over 140 million. And you can see here the breakdown between LAIF as well as with the local government investment pool, CalTrust. And here you can actually see that breakdown again between CalTrust and LAIF. And then for the entire city's portfolio, the consolidated amount, you can see here as of 8/31, average maturity of 0.77 years, the average purchase yield is 0.32%, market yield of 0.18%, average credit quality AA, and the total market value just under 272 million. And then finally, the sector distribution from the consolidated report. You'll notice here that the local government investment pool in CalTrust represents 34.4%, LAIF represents 17%, Treasuries 22%, agencies 17%, and the corporate allocation 5.6%. And then here we have all of the holdings for the city's portfolio based off of the different sectors. Here are the corporate allocations, the negotiable CDs, the supranational debt, United States Treasuries. I mentioned before there is embedded gain built into the portfolio. You can see that right here of 342,000. Embedded gain in the city, unrealized gain in the city's portfolio. And then finally, what we have here is the LAIF and CalTrust reports, and then all of the transactions that occurred over the past 3 months from June, July, and August. And I can answer any questions regarding the city's portfolio or any aspects that I did not cover that you'd like me to go over in more detail.
Thank you. Any questions there? I don't have any. Nancy?
Now we basically meet on a biweekly basis and go over all these. And we're really working towards moving the money from, we have quite a bit in CalTrust and Life, but we don't want to rush it and just go buy things out of proportion. So Mia and Chris have been working diligently with me every other week, going through how much we buy, what should we buy. And like I said, we're really leaning towards a lot of social responsible investing. And it's a hot topic right now throughout governmental entities. And I'm sure there'll be a lot more companies coming out with purchases in the near future.
Thank you, Nancy, and everyone for your work on this. Really appreciate it.
Thank you. Mayor Pro Tem Middleton, do you have any questions at this time? Or comments?
No, you guys have been doing a great job, and no questions at this time other than support of what I've heard.
Great.
And I will be present on the Zoom in just a couple of minutes.
Would you like us to wait for you?
Nope, you keep proceeding, but I'm almost there.
Okay. Well, I think I'm really impressed. They're doing a great job. Chandler Asset Management, and we have a great working relationship. And so if we don't have any other questions or comments, we'll see you next quarter. I don't know, Evelyn, is there anything I have to do before signing off?
No, ma'am. I'll end the meeting as soon as it is adjourned.